Professor Werner, one might assume that in a capitalistic market system all credit needs would be very simply met. But the reports are that in Britain, anyway, small and medium-sized businesses are unable to obtain credit. This must hold back growth. Does it point to something being wrong with the UK banking system, do you think?
Right. Well, let's keep in mind that banks have been given a crucial task in the economy, which at the same time is a privilege. Banks in all countries at the moment have been given the privilege to create the money supply and allocate the money as they see fit. Now, over time, of course, this accumulation of credit allocation decisions by banks will shape the economy.
Right.
Now, despite this crucial role and this long-term impact on the economic landscape, banks weren't told when they were given this privilege to create and allocate the money supply, now go out and do this wisely. They weren't told to do that, and of course what they've been doing is really just look after their own interests.
Right.
As it turns out, they can't even look after themselves. Just look at the banking crisis. So this just shows the great need for banks to receive help from the government in making sure that what they do is good for the banking system in the long run, is sustainable, and most importantly, is good for the economy. Now, when we look at particular countries, say the UK, we find that each country has certain national characteristics in the structure of the banking system.
Okay.
In many ways, the UK is an extreme case.
All right.
But let's just compare the UK with another major economy in Europe, Germany. When we look at the UK banking system, we notice that about 90% of deposits, 90% of the banking market is accounted for by 5 banks. So we have a highly concentrated banking system. These are the 5 main high street banks. And of course, the trouble is when you have so few very, very large banks, and of course also large internationally, they also do business outside the UK, then as a large firm, as a large profit-oriented player, they want to deal with large customers. And that means UK small firms are not very high on their list. In fact, they're more or less a hassle. Because, of course, the cost in terms of doing due diligence and credit analysis of a small firm that wants £20,000 loan
Right.
is about the same as for a large firm that wants £200 million loan.
Right.
But, of course, if you focus only on the big projects, you're neglecting something in the economy. The economy will become much more centralized. The big banks deal mainly with the big firms. And of course, the local economy, regional growth will be neglected.
Right.
And small firms and also startup firms have a very hard time getting funding. And this has been a problem in the UK. Now, let's compare with Germany.
Can I?
Yeah.
So just to recap, in the UK, in sort of marketing terms, the marketing credit doesn't really seem to work because the scale of the main suppliers is a mismatch to the local small needs.
Absolutely.
It's
That's
a
right.
marketing failure.
Yes, well, that's of course because the banks just look after what's good for them, and for
Right.
the banks,
Right, that's the way it is.
It's most attractive and most profitable to only deal with the large firms, so they're not interested in dealing with the small firms. But at the same time, the banks have succeeded through their lobbying, and they're the biggest provider of political campaign money in most countries in the world, also in the UK. They've succeeded in suppressing a whole alternative banking system which is local and small scale. So if we compare the UK with Germany, you find that the 5-6 high street banks accounting for 90% of banking in the UK. In Germany, actually, is only around 12% of the banking market, and the so it's therefore very small. The high street banks in total account for only 12% of the banking market.
Right.
Whereas the majority of banking is actually supplied by many small local banks. Banks with local headquarters. Not a headquarter in London, but say locally in Winchester, there'd be several banks with their headquarters here. That would be sort of the system in Germany. And of course, because each bank is smaller, it's quite happy, in fact, it needs to deal with small customers. And therefore you get a much more diverse economy where local craftsmanship, medium-sized firms, family-owned firms get the support from their banks that they need in the local economy. The two types of banks that make up for this majority of the local economy are basically the credit unions and local municipality-owned or local city-owned or local district publicly owned banks.
Right.
So we've got local publicly owned banks and local credit unions, cooperative banks owned by their members and headquartered locally. The credit unions account for around 30% of banking in Germany, and the local government-owned banks account for around 40%. So in total, 70% is accounted for by these local banks.
Right.
And of course, that creates a completely different dynamics, and it goes back to the point that your banking system will ultimately shape your economy. Here is a banking system in Germany where it's the local needs that will be listened to, and the local bank in a local small town, because it's headquartered there, can make the decisions.
Right.
Here, you have to go to High Street in the UK, High Street Bank branch, and most of the time they will ask headquarters, some kind of anonymous credit scoring program is going to make the decision.
Right.
Of course, this is also not very good for trust and mutual credibility, and of course to make a loan sustainable, it's very important that there is a relationship of trust between the bank and the customer. And this is much more likely to take place on a local, smaller scale, where the bank knows the customer and the customer knows the bank, and perhaps as a child grew up knowing this bank manager,
right.
And so on. So, how likely is it that he's going to run with the money?
Right,
It's far less likely in this much more local, also personal, person-to-person based system.
Right, and it also gives a money supply, a local money supply.
Exactly, that's the other component. I mean, in the UK and many other countries in the last 10, 20 years, people have realized that for sustainable economic activity, we also need to encourage local economic activity where there's not such carbon mileage in transporting things around the world. And so this idea of local currencies is being promoted. And this Lewis pound, for example, or some local currencies, they've been issued.
That's
now.
Lewis in Sussex in
That's
England. Yeah,
yes.
Yeah.
Now, these systems, they don't add to the money supply. Actually, there is already a local currency system in place in countries such as Germany, where we have these local credit unions and the local publicly owned banks. Because, of course, as we said, when banks grant credit, they create money. So that's your local money supply that is injected locally.
Right. Where it's wanted.
So you do get a much more decentralized economy that responds much better to local needs, and there's much more diversity in such a system. And of course, a more centralized system tends to be just good for the very few oligopolistic banks.
Yeah, so Germany's got a good record of growth, steady growth over quite a length of time.
Yes, looking at the financial crisis, of course, also makes this point that these locally headquartered banks, they're not interested in the speculative credit very much, because that's particularly attractive to the large banks.
Right.
Whereas the local banks want to lend locally, and they're not very much interested in investing in, say, credit derivatives based on US subprime or some other foreign, financial instruments.
Right.
As a result, they did very well in the financial crisis, and therefore it's clear that this is much more sustainable. It leads to more stable growth, fewer economic cycles, and when there's a crisis, there's more durability in the system.
Right.
And so these are key advantages of a locally based,
right.
decentralized
right.
credit system.
Right. So this credit union type of banking, what's the scale of it in the UK?
In the UK, credit unions are tiny. They account for less than 2% of banking. So that's a shockingly low number. In Germany, as we said, it's around 30%. In fact, in many countries in both Europe, but also, say, even Ireland or Canada and the US, credit unions are a much bigger part of the economy. So, well, basically legislation in the UK has been very much against credit unions, and legislation has favoured the large banks. So, of course, the role of the authorities is very important, and certainly in some countries, in Germany, the credit unions have been always part of the system, and the regulators have always allowed them to create and allocate credit.
Right.
So the role of the regulators is important. In Germany, the Bundesbank, the central bank, well, before the introduction of the euro and the ECB, was the independent central bank. It was also a key bank regulator, and it's succeeded really in avoiding an asset bubble. In Germany, there hasn't been an asset bubble since the Second World War.
Right.
While the Bundesbank was independent, now it's a different story with the ECB. Of course, that's what's likely to happen next. But you see, the role of the central bank is also important.
Right. One would have thought that with the good example of Germany having sustainable growth over a long period, that other countries around the world are learning from that example. Is that so?
Unfortunately, no. That's not what's happening. Quite the contrary. Both the European Union and also other international organizations are putting enormous pressure on Germany to get rid of its quite successful system. Even the Basel III capital adequacy is putting pressure on the likes of credit unions, credit cooperatives.
Really?
And there's very strong pressure from the EU competition commission to really break up the banking system. Now, of course, this is, I think, ultimately the banks, the big banks, the high street banks talking. They want to get rid of this competition.
Right. Yeah, right.
But of course, we see that this is much more in line with a sustainable, stable economic growth type of system, and therefore we shouldn't abolish them. We should encourage them in other countries such as the UK.
Right. So you see this as a banking for a big society bank really needs to be a big society banking, a completely different
and the bank
look at the system.
And the
really.
banks should be small, really.
Right.
So
right.
big society bank should consist of many small banks.
Right. Thanks very much. On our next video, Professor Werner will talk about debt-free and interest-free money.